All right, we got the recorder going. Vishal, hello. We are um, we are discussing Qorvo earnings after the close today. Big supplier to Apple. Okay. Yeah. Right. Right. That's a homonym, right? Homophone. Is that what they call that? Sounds the same, spelled differently. Um, the stock was a big high flyer for a while, peaked out late last summer, and has been on a very, very big downward trend ever since, which I'm going to pull up here. Now, much like every other stock we look at, here's basically the December crash was right here. We've had a really nice rally back, and now we're just kind of sitting here. Okay, so about a month ago, they came out and guided their earnings forecast down. Their revenues they guided down, and actually pretty big, actually. A pretty big guidance down, and I think that was this big drop right here from this 79 level down all the way to where it went to 54. So we are at a point here where we're kind of sitting right in the middle of no man's land. Now, remember that 50% retracement thing that we talked about? You look at the high that it was trading, you look at the low that it was trading, take the difference, divide by 2, and you get this 50% retracement. Something that, is a very, very strong technical indicator, especially when you can put that together with other indicators. Well, if we look at the high in Qorvo, which is roughly 87, Shane, the longer period of time you can look at it, the better. You can look at it any time frame you want, but the more data, meaning the longer period of time, the more predictable, the more accurate this type of indicator is. Okay, so if we look at that high of almost 87, the low of 54, the difference is 33 bucks. If we split that 33 bucks in half, we get 16 and a half, right? If you take 16 and a half off of, or added to the low point here, look where you get to. Look where you get to. Almost to the penny. Almost to the penny. The rally back where it stalled. It's not just coincidence, guys. I'm not saying that this is the end-all be-all. It's just another technical indicator that's out there that is a very powerful one. So did everybody follow what I just looked at? Did everybody see that? And I can whiteboard it if you didn't. Okay, let me whiteboard it for everybody. And I'm going to just use this under here. Okay, so the stock right now, 66 and a half. Okay, the high in the stock was 86.84, which was back in March. The low, the recent low since then, okay, since that period of time when it hit that high, was right here at 54.74. Low is 54.74. Okay? The difference from high to low is $32.10. Right? The 50% retracement indicator says that when a stock retraces 50% from its high to low, or could be the other way as well, or low to high, that is an indication that the stock is ready to reverse back. Okay, so in this example, we got, again, almost to the penny, that rally back of 50%. And look what happened here. Boom. We're down $4 off of that right now. Okay. So this to me, Qorvo is definitely in a bearish pattern, though I will tell you, Skyworks, as we know, another big Apple supplier, actually had poor numbers but guided higher, and the stock took off. The other thing, the other big difference is that Qorvo, like I said, about a month ago, they already guided much, much lower. So what the street is looking for in their earnings report is actually pretty low already. So if they beat that, you could see a big rally. If they miss on that already lower guidance, look out below. So this is going to be a real interesting one to evaluate. You know, in terms of a position directionally, I can absolutely make a case for either bullish or bearish here. So let's take a look at what the expected move is. Let's see what the markets are looking like here. I would expect volatility to be pretty darn expensive and up today because we're sitting right in that middle of a potential move. So let's take a look. Now there are no weekly options. These are only monthly options. Okay, so we are looking only at next week's options, February 15th. So, Jamie, the stock is 66.5. So we're sitting right in the middle of two strikes, of the 65 strike and of the 67.5 strike. Makes it a little bit more difficult to calculate the expected move. A little bit different of a calculation, but we're going to go through both ways of how we calculate that. Okay? The first and easiest way and least accurate, so when I say least accurate, I don't mean it's not a good calculation, but just the least accurate is to, since we're sitting right in the middle of two strikes, is to look at the put and the call, the strangle, surrounding the stock price. So the 65 put, 67.5 call, we look at those together, we get about $3.80. Everybody see that? If I add the 65 put, 67.5 call together, it's about $3.80. Okay. The other thing, the other way we can look at this is to take the closest at the money straddle. Now in this case, you can choose either the 65 or the 67.5 because they're both equidistant away. Okay, so let's choose the 65 straddle. 65 straddle is $5.10. Right? 3.25 plus $1.82. I'm rounding off, so it's $5.10. Everybody with me on that? We then take the put below and the call above. So the put below that strata would be the 62.5 put, which is $1. So now we're up to $6, let's say. The call above is $1.95. If I add that in, now I'm up to, let's call it $8. And divide that by 2. Divide that by 2. And that gives us around a $4 expected move, which is right in line. Thinkorswim has shown $4.23. That gives us about a $4 expected move. So looking at that first strangle, the 65, 67.5 strangle, it's not so far off from looking at the more detailed way of doing this. But obviously we want to, we want to be as accurate as we possibly can. So I look at this, that there's about a $4 expected move. Okay, everybody with me? So that gives us an expected range of 62.50 up to 70.50. Okay, 62.50, 70.50. Anything of note here? Well, technically, you've got the 50-day moving average literally right at 62. What is it? 62.45. So you got 50-day moving average right there. Upside, you have that recent high just made yesterday, in fact, which was the 50% retracement level, right at 70.5. So from the perspective of technical data, support resistance, pretty strong, both on the buy and the sell, the support and resistance side, compared to what that expected range is, which tells me one of two things. If I'm non-directional, I either want to do an iron condor if it works out, or possibly a strangle swap, depending on volatility. Okay, so let's take a look at the option prices here. Again, we're looking at 62.5 and 70.5 as our targets. So let's say we do the 65, 62.5 and the 70, 72.5 iron condor. Okay, $1.30 sure looks good, right? That's more than half of what the iron condor is, but and it's a little bit more difficult because the strikes, are $2.50 wide instead of dollar wide strikes. But if we do that, the break even on that is 63.70 up to 71.30. Obviously, that looks really good. Did I say something? Oh. That's weird. Obviously, that looks good compared to the upside expected move, but a little shy on the downside. The $1.30 is certainly good. It's more than half, but definitely gives us some risk to the downside here. Okay, everybody following? Okay, let's look at a strangle swap. Strangle swap, we can get really close to the strikes we're looking at. We can do the 62.5 and we can do the 70 strike. The problem is we have to go a full month out. A full month out. Because there are no weekly options. Let's see what volatility is doing out in March. Okay, based on my projection here, this strangle swap is going to cost somewhere in the range of probably $1.90 or so. The market is $1.55, offered at $2.20. Okay, so probably $1.85, $1.90, somewhere in that range. And if I look at this, even holding this close to expiration, and you know, we don't want to hold an earnings trade for a week, but even if we held this to closer to expiration next week, this P&L obviously does not look good down here, right? So not a strangle swap I'd really be interested in. Going back to your questions here, Roger, why not the 62.5, 60? Well, that'll certainly help out with the break even to the downside, but what is that also going to really do and harm from the price of the iron condor standpoint? Look what it did. So again, it certainly helps with the break even levels, but now look at what the pricing is. Probably trading right about $1. If I could do that for close to, you know, $1.15, $1.20, I'm all in because I've reduced my risk. But now I'm also taking in, if it's $1 versus $1.30, I'm now taking in 25% less premium. So very good thought. You know, in a perfect world, ideal world, I'd love to do that. But obviously, you know, as we know with every setup, when we're taking less risk, we should expect less reward and vice versa. Question? Or, okay.
It just went away.
Can't refresh it?
Try.
Why don't we get you logged in just on a computer instead of the tablet? Okay. You want to log in on my laptop? Right here?
Yeah.
You can. All right, give me 2 minutes. All right, so, well, Jaytano, what you're doing then is really increasing your risk. Big time increasing your risk. You're going to get a little bit more credit, but now you're really widening out your risk if you get a big outsized move. You now have a $5 wide iron condor, $5 of risk for only collecting, let's say, $1.50. See that? Okay, so let's go through that. If you buy that at $1.50, Jaytano, where does the stock have to go for you to at least break even? Where would be the break-even point on that? Regardless of whether you buy or sell it, where's the break-even on that for $1.50? Anybody, not just Jaytano. Where's the break-even on that? Exactly, 71.50, but not 61.50, Jaytano. 61. Okay, 71, 50, and 61. And as Roger just said, what is the expected range? Right? The expected range is only to 62, 50, and 70, 50. So therein lies the rub. I'm not saying not to do that, but I'm just, pointing out that that is what the downside is. Okay? So back to our potential setup, what do we do? And my answer to you is, I don't know. After all of that evaluation, I feel like this is one of those times where we're trying to fit a square peg in a round hole. And with all the other opportunities that we're seeing out there, I think the best decision is to pass and move on to the next one. All right? Again, no FOMO. Take our emotion out of this. I know we all want to, be excited and trade and this, that, and the other, but it's got to be a real good reason why to do that. Okay? All right, let me get this posted in the room, and I'll be back. And we're going to go in there, and we'll work on some volatility stuff.
Okay.
Okay? Let me just...